Hi everybody, this is Sean Morrissey coming to you live from downtown Aurora with Chicagoland Realty Group Partners. And
I'm Glenn Marino with First Centennial Mortgage, the branch manager, also coming to you from beautiful downtown Aurora. And we're here today with your
Tip of the week. So today we're covering video 3 of 3 and what buckets of cash your funds are going to come out of when purchasing a home. So video 1 we covered down payment assistance. Video 2 we covered closing costs and ways you can structure that to save the most money at closing. And video number 3 today we're going to cover prepaid interest and escrow, with the idea that in a perfect world you can go to the closing table with less than 1% of your down payment out of your pocket. So without further ado, I'm going to let Glenn take over and inform us what we got to do to make that happen.
Well, Sean, it's pretty exciting. Like you mentioned, that people could buy a home for as little as 1% or less than 1%.
Yeah, crazy.
And again, everybody kind of understands down payment. Everybody kind of understands closing costs. This is probably the most confusing bucket, but we're going to try and walk people through it so they get a better understanding of what's involved here.
Perfect.
And so in the world of prepaid interest and escrows, we have to understand that most real estate professionals, Sean, myself, when we counsel buyers, we ask them to set up their contract to close toward the end of the month. Well, why do we want to have them close toward the end of the month? Because they owe the lender what's called prepaid interest, and they paid from the date of their closing to the end of the month. Well, if I close on, say, May 1st, I'm going to owe 31 days worth of interest.
Yep.
Big number. Versus if I close on May 31st, I owe 1 day's worth of interest. In our example here on the whiteboard, we're assuming 1 day's worth of interest, or our client's going to pay $40. So we got $40 in this bucket for prepaid interest and escrows. Then the second major section that someone has to worry about in this bucket of cash is the escrows. Fancy term for what do I have to deposit with the lender? And why am I depositing these? Because the lender is going to pay for your hazard or homeowner's insurance. That protects it against fire or damage.
Yep.
And they're going to escrow for real estate taxes. So let's go to the homeowner's insurance first, because it's pretty easy. First thing is, any buyer is going to have to go to their insurance company, be it Allstate, State Farm, wherever they go and get their insurance. And they're going to have to come to the closing with what's called a 12-month paid-up policy. Okay, so they're going to pay $360, $400 for their insurance premium and show evidence that they've got a paid-up policy. The lender then will collect at the closing 2 months, what we call the cushion, 2 months worth. So again, using an example, if the premium was $360, Sean, divide that by 12, that's $30 a month. Okay, so two months times 30, $60 is what our client is going to have to escrow at the closing.
Yep.
Okay, so far so good. Now we get to real estate taxes.
Confusing part.
Yeah, very confusing part, absolutely. And we're going to try and make it as easy as possible. It depends on the month that you close in. You could be setting aside as little as 2 months worth of real estate taxes, and you could be setting aside as much as 8, 9, 10 months worth of real estate taxes, depending upon the month you close in. In our example here, Sean and I are assuming it's a Cook County closing. Their taxes, the real estate taxes, are due on March 1st, and they're due on September 1st. So if I'm closing on May 31st, it's now 3 months after that March 1st payment, I have that first installment of real estate taxes for Cook County that was due March 1st was paid by the seller. So on May 1st or May 31st, our client is going to set aside 6 months worth of real estate taxes. Assume the tax bill is $3,600 a year, divide by 12, that's $300 a month. 6 times 300 is $1,800. Okay, totally makes some sense. But what we want to also then find out is the seller going to give us any type of credit for the number of months that they have lived in the house? We here in Illinois, this is a very, very important point. Illinois buyers, the state of Illinois requires that the real estate taxes are paid in arrears. Fancy term for they're paid the prior year, you're paying in the current year. Saying it differently, in 2017, we're paying for 2016 real estate taxes. So if the first installment's already been paid, that means then the seller owes for the seller's tax credit, they owe the buyer, our customer, 6 months of the 2016 taxes that are going to get paid here right before September 1st. So our client will physically pay the bill because they'll be in the house at the time, but the money for it will come from the seller in the form of 6 months of a credit. Now let's roll forward to 2017. Remember, the client, the purchase transaction is closing on May 31st. That means that there's 5 months into 2017. The seller's lived in the house for 5 months. So for the 5 months of 2017, the seller must also give our customer, the buyer, you, will get a credit from the seller for that. So let's add the two together. You got 5 months in 2017, 6 months in 2016. That hasn't been paid yet. It is the responsibility of the seller. When you add those two together, that's 11 months of credit times $300 a month. So that's $3,300 that the seller just gave our client in a credit. And when we get that credit to offset the $1,800 that the lender is going to require to be held in the escrow, and the $60 that the lender is going to require for homeowners, and the $40 for prepaid interest, the sum total of that bucket is a minus $1,400. So the point being made here is that your third bucket will always be either a zero or a negative number, which means you're going to bring less money to closing. It's going to offset the amount of funds that you have to bring to closing. So if Sean can help you out, if we can help you out with buying a home for as little as 1% down, you can have Sean help you structure the deal to where your closing costs are little to nothing to zero. And then your third bucket is a negative number. When you add all three buckets together, you're buying a home for as little as 1% or less of the purchase price.
Well, and in referring to that first video, we talked about rent and security deposit, and you take that example into account, and ultimately you can purchase for less than what it would take to rent. All you need is the credit score in place and real estate professionals that are attuned to this stuff so that it can be structured properly.
And Sean, how can they get a hold of you if someone wants to take advantage of them? I mean, it's coming to the spring market.
Yep.
People need to be able to say, how do I take advantage of this?
Well, I'll just give everybody my cell phone. You can reach me directly on my cell at 630-881-7082. And Glenn, how about yourself?
You can get a hold of me over at First Centennial at area code 630-983-3604. Sean and I are here to, first off, answer any questions, get you pre-approved for free, or even help you with some credit repair if that's what's necessary.
Yeah, exactly. And if you think this video is going to be helpful towards any friends, please go ahead and share it on whatever means you see necessary, and would be happy to help your friends out as well. In the meantime, there's lots of information here, especially when it comes to the real estate taxes. So remember, there's always that rewind button, so you can watch it again and have it sink in a little bit deeper. But in the meantime, we appreciate everybody watching.
And we'll be here in next week with another
Tip of the week. Thanks everybody for watching. We'll see you next time. Bye-bye.